Let's bring in Bill Campbell, portfolio manager at the investment management firm DoubleLine. Of course, Heidi was talking about the Fed's trajectory. What do you expect to see in the jobs numbers this week that could have implications also for the Treasury space?
Hi, thank you for having me. I think that there have been a lot of big stories over the course of this year. You covered the biggest one, the falling U.S. dollar. But more recently, on top of easing trade tensions and easing geopolitical tensions, we've really seen U.S. yields start to come meaningfully lower. And that's helped global yields, even in Asia. When we look at the JGB, long end of the interest rate curve there, come lower as well. I think that the Fed is going to continue their wait and see policy, as there are a lot of big questions not only for the U.S. markets, but for Asian markets as well, revolving first around inflation, where Jay Powell is taking a wait and see approach to see if the pass through from the tariff policy so far and the weaker dollar will eventually lead to higher near-term inflation outcomes. But balanced against that, we need to keep a very close eye on if the labor market starts to crack. I know the market, the forecasted expectations for this Thursday's non-farm payrolls numbers, 110,000 as of the last time I checked earlier today. I think that's about fair. I don't think the U.S. labor market is breaking in a meaningful way at the moment. We are watching rise in continuing claims, but we also have seen an increase in U.S. immigration policy that has allowed for the labor market to remain strong despite the lower headline non-farm payrolls prints. So I think when you combine all of that into the picture for the outlook for the Fed, it keeps them on hold through this summer, and then we'll get a better clue, I think, as we enter the fall, on both what the inflation outlook looks like, but also more importantly, what the growth outlook looks like. And the subdued growth outlook and the potential for, if labor markets do start to weaken, keep a September cut potentially on the table.
So if you have the Fed cutting rates without the U.S. economy crumbling, that will really help risk assets, right? What are the expectations of where the opportunities could be during that transition for Asia? Yeah,
I think, look, if the Fed starts to cut interest rates, the other item that we really should focus on is there's the passage of the U.S. budget bill that's likely to happen by the end of this week in the United States. So that will be a net positive for pushing forward fiscal stimulus. My concern is that if the Fed starts cutting interest rates into the end of this year with increased fiscal issues, we could potentially see further weakness on the dollar that's going to put upward pressure on currencies, especially in Asia. When I look across the Asian markets, I think, the real question is, are we going to see a CapEx cycle build up? I know the Tenkan numbers just came out and, they look decent, but when we looked at the May industrial production numbers from last night, there was still clear weakness across the export sector from Japan to Korea. I do think that the Bank of Korea has another cut or two left in it in this cycle for this year, as growth for both Japan and Korea remains subdued. It is interesting that we continue to see China post PPI deflation. I think that is going to be a headwind for inflation in Asian markets as well as European markets. But one interesting aspect that in the currency markets, we are all focusing on the crosses with the dollar. But when we look at crosses versus the euro yen is moving up to near-term highs. Euro CNY is also moving up, to near-term highs. And that presents the other big market for exporting for Asian countries outside of the U.S. is Europe. And this gain in competitiveness due to the fact that the euro dollar is rising, I think is a potential net benefit for Asian markets.
How do you invest around sovereign bonds at the moment? Because clearly this is not just a Treasury story, it's not just a JGB story. Is this a global sort of scenario when it comes to the longer end of the curve?
Yeah, I think we're avoiding the long end of the curve globally, where we prefer to be underweight across developed markets, at tenors above 10 or 15 years. So really the super long end of the curve, whether it's Europe, Japan, the UK, as well as the US, we prefer to be underweight there. But what we do think is likely to happen is we think that a virtuous cycle is likely to start building up with capital flows moving away from just U.S. assets back into international markets. I think that that is going to be, a net benefit to the global economy over the next year or so, with with the best expression of that being in emerging markets. So emerging market local currencies are on the top of our list. We think they're undervalued, they're underowned. The emerging market allocation for many allocators has been on a back burner due to the large risks that that sector has faced historically. But we think that that is undergoing a sea change at the moment. We think that large fiscal stimulus and the redirection of capital is only going to increase capital to emerging markets such as India, Indonesia, and other ASEAN, emerging market countries that present very interesting risk return characteristics when we look out over the course of the next year and a half. So that's the next, outside of avoiding the 30-year, we are actually increasing allocations to our emerging market local currency strategies. And that's, we think, going to be a very interesting place for investors over the coming quarters to, maybe the next several years.
What about allocation to China?
We're still a little bit hesitant on the allocation to China. I think that we saw the decent growth so far this year was really supported by pull forward of fiscal stimulus. And then we need to watch very closely what's going to happen with the July Politburo meeting. It's my expectation that we're going to see maybe an underwhelming of what the expectation for fiscal stimulus is out of that meeting. And the reason for that is the better than anticipated tone of trades negotiations that are happening between the U.S. and China. China is going to save its bullets. When we look at the Chinese property sector, we continue to see stresses. We heard from the PBOC over the weekend that they pulled back on the explicit, their explicit messaging for near-term RRR cuts if necessary. They're pulling back on that dovish rhetoric as well, and that's going to, potentially slow growth at the margin. Now, that being said, I don't think you're going to have an imminent collapse in China. I think what they were trying to do was manage what potentially was a large exogenous risk of trade negotiations with the U.S., which are now trending a little bit better. But ultimately, I think a lower trend growth rate across the globe, especially the Asian region, is more likely. But I think this is really a capital flow story that not only international investment into the U.S. is going to find new places, but China is going to be looking to find additional markets, not only to sell to, but also to invest in. And as we know, China takes a long-term approach to investment. When they come in, they offer cheap capital financing, and that tends to be a net growth driver for the emerging market countries that partner with China.
Bill, great to have you with us. Bill Campbell is a portfolio manager at investment management firm DoubleLine.